Spotlight. My name is Leanne Alfaro, and we are live in Times Square on the heels of the iGlobal REIT Summit. So joining me right now is Rusty Fleming and Lee Hart, who are partners at Nelson Mullins. Thank you so much for joining us.
Thanks for having us.
Thank you for having us.
So you both are real estate experts, or connoisseurs, so to speak. Tell us a little bit about the podcast that you have within
sure.
that arena.
Yeah, so I have a podcast called The Deal Junkies, my partner Bo Baker and I. We talk everything commercial real estate finance. We usually have guests on where we cover everything from mezzanine finance to the latest trends in real estate finance. So yeah, it's available on iTunes, Spotify, anywhere you get your podcast. Again, it's The Deal Junkies, and then Lee launched a podcast a couple of months ago.
Yeah, that's right. So after having listened and enjoyed Rusty's podcast, I launched one called Back in Black. It is also a real estate-centric podcast. I have a background as a bankruptcy lawyer, and our concept here was to look at economic data and try to get distressed real estate investments out to our client base and anybody else that might be interested in that kind of stuff. So we're constantly combing opportunities and economic data and putting that stuff out into the sphere and talking to people about it to take, assets that need to be restructured and create value out of them. So it's been great.
Fantastic. So podcasting is the way to go. Can we find this on Apple?
Yes, it's on
podcast.
both are on iTunes,
Perfect.
Google Play, Spotify.
That's right. Find us on your smartphone.
Perfect.
That's
Great. So we'll be sure to ask people to check that out. Now tell us, how are the real estate capital markets performing today?
I think all in all pretty efficiently. I think we're seeing a lot of capital out there. It is being put to use in many ways, and one of those is through the capital markets, either through leveraging debt platforms, using other debt platforms through repo facilities or warehouse lines, or through CLOs and CMBS. I think there's maybe a little softness still with CMBS. There's just not an appetite for it. So you're not seeing as many deals go to market with CMBS, but CLOs for sure.
Yeah, so this is something that we've been talking about a little bit on, and on the way over here. I mean, it seems, since there isn't as much of an appetite for sort of the 10-year fixed conduit style loans, that the capital markets efficiently adjusted to figure out other vehicles through which they could deploy capital. So CLOs are ticking up and filling that void, and we're seeing sort of more creative, more malleable loan structures that borrowers are more comfortable with. So the volume is certainly there. It's just that the shape is a little bit different than it was last time around, and that to us is a hallmark of efficiency because it's adaptive to the climate, to the market.
And I think in the multifamily space, Freddie Mac, Fannie Mae, especially the Freddie Mac K series where they're using securitizations for multifamily, very efficient. Those are rolling out a couple of months.
Oh, yeah.
It's high volume, so that's going very well. So I would say all in all, doing pretty well.
And when it comes to real estate, multifamily is pretty big.
It is. We're based in Atlanta. You look outside our office window, and every crane you see is a new high-rise multifamily going up with record-breaking rents. So Atlanta's a little unique in that our population is growing rapidly, about 100,000 a year. So there's good absorption there, but multifamily is still the darling for sure.
It is, absolutely, and it has the lowest default rate, and has for a while, of all the real estate asset classes in the secondary market now, according to the numbers. So it really, you almost can't go wrong with a multifamily investment, or at least that's the way it's being
That's
viewed
what
right now.
people think.
Right, and that falls under the heading of famous last words.
Yeah, that's right.
But we're seeing a lot of it.
Yeah, there is some pullback in construction lending, particularly in the multi-space, just because, I think that lenders are concerned about the absorption. Also, just the cost of land inside major metropolitan areas is shot up so much that it's making it very difficult to obtain favorable financing. So I think people are looking for ways to either move out into some more less urban areas where they can get a little more value but still command the rent. So there's people are still doing deals, but there's been a little pullback, I would say, in construction, which is not a bad thing. They're just filling it with non-traditional construction lenders, private equity, things like that.
Absolutely. Now tell us, how are our deals being structured?
So I think that this parlays really nicely off of what Rusty just said. As once sort of the construction lending is done and you've got a finished building, borrowers are figuring out ways to leverage and structure their assets much more than they had in the past. And so what we mean by that is tiered debt. So the mortgage debt, which is the traditional first lien mortgage, has been around for a long time, obviously, and so is mezzanine lending, which to us in the real estate world essentially means that the loan is to the parent of the borrower, so it's just one level removed from the property. But beyond that, we're seeing preferred equity, and then we're seeing other types of creative sort of mezzanine financing structures, second level mezzanine. We saw a deal recently with mezzanine backed by EB-5 money, which is an international visa program. So people are getting really creative in ways to pull money into their projects where the first lien mortgage might not be enough.
And I think that part of that story is chasing yield. So the farther you go up the capital stack, so this deal we were talking about, that Lee was talking about, you had senior, you had mezz, you had pref equity, you had EB-5, and then you had the common equity. And as you went up the chain, everyone was trying to get the highest yield they could on their money. So they were willing to take a little more risk as you go up the capital stack. And there's only so much senior financing to go around, and the yield is still pretty low, even though we're in a rising rate market. People are chasing yield, they're going up the stack, and they're getting comfortable with that. So we're seeing that. And then other things like CPACE, property assessed clean energy financing, which can be a cheap alternative to mezz financing. Again, you mentioned EB-5, that's still out there. So people are being creative to get their deals done. And so from a structural standpoint, that's what we're seeing. There are no just down the middle, senior 10-year fixed rate deals. They're 3-year bridge deals with multiple layers of debt. So it makes it interesting for us.
Yeah,
I'm sure.
for sure.
Now tell us, are there any legal trends impacting real estate finance right now?
Well, I think the big one that we have recognized is actually a case that is out of the New York court systems, and this was very recent. There have been, I think, some questions and frankly fears about whether or not a borrower's right to redeem its loan might get in the way of mezzanine collateral, might get in the way of the exercise of a pledge in the equity of the company that owns the property. That's sort of a lot of words, but essentially it would be sort of an equitable reach of this right to pay off a loan to a different company. And the New York courts just very recently, I think just a few months ago, came down and said, no, that's not a problem. And so from our perspective, that clears up questions about mezzanine lending and enforcement on mezzanine collateral. But more than that, it opens up opportunities to take a pledge of equity to secure a mortgage loan, which is a very helpful item when you're talking about exercise of remedies from a mortgage perspective and making sure that you're covered if you're the first lien.
Yeah, I would say that's probably the number one thing that we're seeing right now is particularly in states that are judicial foreclosure states where it may take you 9 months, a year, maybe even longer to foreclose. Lenders are hesitant to lend in those states because of the increased risk. And then you're dealing with the court, you've got some unknowns there. So one way to mitigate that is to borrow from what's traditionally a mezzanine concept of taking an equity pledge and doing it in connection with the senior loan. So now if you have a property that goes into distress, you've got 2 avenues to seek your remedies. You could foreclose the traditional senior route, or you could foreclose on your equity collateral, which might have a 60-day time period versus 9 months to 12 months. And so much easier to realize as the lender, realize upon your security, make sure that you're protecting your property, and then get that property back on the market to recoup your funds.
Yeah, that's right. That UCC foreclosure process of your pledge, by and large, is a non-judicial foreclosure process. So there's no lawsuit, there's no court system.
Right.
There's, of course, the challenges that can be presented against borrowers, or I'm sorry, against lenders if borrowers sue, like there always are. But generally speaking, it sort of restores the rights to a non-judicial feel from even in a judicial foreclosure state. So that could be that is a huge legal development that we think will help.
I think particularly when your lenders in the private equity space, they've got set time frames for return of equity to their investors, and there's certain IRRs that they've got to hit, and so they can't sit around 9 to 12 months waiting on a foreclosure process. They need to move quicker, their capital needs to churn faster, and this is a way for them to do that. So we're particularly seeing that with your non-traditional lenders, which there are more of those today than ever before. Non-bank lenders, and
Right.
so this is another tool that they have.
And in terms of popularity of that, you were just talking about that on your podcast this last week, right?
Right.
Or this last episode, about how your guest is seeing more and more of these types of pledges serving as collateral, both for mezzanine style loans and for traditional first lien mortgage loans.
That's correct.
Yeah.
Do we see those trends more in some parts of the country more so than others?
Well, yeah, because the mezzanine concept is nationwide, but where that would be really helpful for a mortgage lender would be in states that require judicial foreclosure. So New York is a big one, Florida is a big one. States where you have to file a lawsuit and potentially have a 6 to 12 month lead time before you actually take the property back. Illinois is one. Those states is where this is going to be really helpful.
Yeah, versus if you're doing something in Texas where you have a relatively straightforward
non-judicial
foreclosure process,
yeah.
not as big of an issue, but in New York it's a big issue, and that's where this case that Lee mentioned came from. So that was huge.
Yeah.
So very applicable
Yeah,
here.
absolutely.
Now, shifting gears a little bit, what are some of the creative ways in which you've seen people or capital deployed to chase higher yield, which you were talking about a little bit earlier?
So I think there are a few things. Some traditional banks are not making first mortgage loans. They're making repurchase facilities or warehouse loans to other private equity lenders. So they are leveraging their balance sheet instead of being in maybe a first position with a fixed rate loan at a pretty low yield. They're making loans to a PE shop that then is going out and making loans at a higher yield, and they're getting that arbitrage. So I think that's one thing that we're seeing, and it's putting more capital into the markets where a PE shop can then leverage up their balance sheet at 70-80% and make more loans. So we're seeing that. I think some of the things we mentioned earlier, going up the capital stack with mezzanine financing, C-PACE, EB5, pref equity. I think people are just being creative because there are not as many deals. And when you find a deal, you want to do all you can to squeeze every dollar out of it. And of course, as you go up, you're getting the borrower's getting a little more leverage. They're paying for it, but they're okay with that as long as they can get that last dollar out of the property.
Yeah, and there's an appetite for it in the marketplace and a willingness to entertain it by the borrowers in the secondary market. And some of this harkens back to what we talked about at the very beginning, with there being less fixed rate conduit loans and more sort of creative CLO type loans that are willing to entertain some of these things that have more structure on them. And I think that a lot of it's just driven by purely the amount of capital in the market. I mean, there's a theory out there that from a lot of the money that was pumped into the economy by the Fed over the last call it 10 years or so of quantitative easing, a lot of that money fell into the hands of ultimately of these equity funds that have a mandate to deploy it, and they've got a targeted yield for their investors, and so they're out there trying to figure out how to structure the deals to obtain that yield. And as Rusty said, there's just a limited amount of deals.
And I think borrowers are looking for more return on their projects as well. So there's a lot of value add right now. I mean, we're doing a ton of bridge deals where you're taking a property built in the 70s or 80s that has sort of been maintained but not necessarily updated, and versus the guy across the street that's building a ground up development and has all of that cost. You're seeing borrowers take that 1980s property and do a major renovation, increase rents 20, 30, 40%, and getting their money out. And lenders are being aggressive with term sheets on those, future funding those capital improvements, almost like it's a construction light type of loan. So we're doing a ton of those deals and seeing a lot of that in the markets, and that's nationwide.
Yeah, and lenders are more willing to do that now because these are CLO type loans, and those types of loans are able to be moved into the secondary market now, whereas before perhaps not so much because they're just not appropriate for a REMIC.
Yeah, there's a common theme here. The capital markets are being efficient through the CLOs. Borrowers are demanding bridge financing. Those fit well into CLOs. It it's very efficient. It is working.
That's right.
And so as long as each cog of the wheel continues to work efficiently, we're going to keep seeing a lot of loans be made.
Yeah.
Are you seeing any softness in the real estate market?
I mean, we are seeing some in pockets, and the softness seems to be sort of microeconomic based. I'll give you an example. We got Kroll's KLOC index updated for July just about a week ago, and one of the vintages was pulled down. One of the vintages of loans was pulled down pretty substantially because of softness in the Houston office market, and that, of course, is driven by consolidation and paring down of office space in the energy industry. So Houston office seems to be a little bit soft in the energy corridor. Conversely, we just purely anecdotally have seen a number of issues in the hospitality space out in Arizona, and that might be coincidence, or that may be a national trend or an area trend. We're just not sure yet. So, it seems to be that as you drill down into particular micro markets, you can get a feel for where there may be softness, but on the whole, the economy seems to be doing well. I mean, the default rate is at last month for secondary market loans just reached a new post-crisis low, and this is, I don't know, the fourth or fifth post-crisis low we've had in a row. So it's going to be a low now until next month, when it may be lower.
That's right.
So the markets are performing well, and generally speaking, the assets are performing well.
Yeah, I think Lee's spot on. It's micro, it's borrower specific. It might be, we saw some hotels in Indiana because there was a major relocation of Caterpillar.
Cat moved.
And so you see those things, but on the whole, not anything to be concerned about at a macro level. And there's definitely plenty of capital. So, are we going to get a dip? Of course, we're going to get a dip. But I don't think there's going to be a credit crunch. I think there's going to be plenty of capital. There's going to be plenty of opportunities, and hopefully everyone is going to be well positioned for that.
Yeah. It's going to be about marking the new fair market value of the assets once there's the dip, and then redeploying the capital against those assets in a way that makes sense for their values.
I agree. I think it's going to be more of a price correction on the buy-sell side than it is going to be a lack of capital. I think there's going to be some folks that have to reset their expectations, and we're seeing that a little bit. We've got clients that traditionally do development work, and they're sort of in a wait-and-see mode right now because prices have got a little frothy. But they're still looking for opportunities, and they'll do it if the numbers are right, and they can go find capital if the numbers right. So that's the important takeaway here. That deals are still getting done, and you can still get deals done.
Definitely. Well, thank you so much. Really good insight from both of you, Rusty and Lee.
Great. Thanks for having us.
Yeah, thank you for having us.
Absolutely. Thank you for being here. Nasdaq followers, that has been Rusty Fleming and Lee Hart from Nelson Mullins. Please stay tuned with us. We'll have more experts and speakers on the heels of the iGlobal REIT Summit happening in New York City starting tomorrow.